Today is Friday, March 5th, 2021, and I'm your host, Max Gottlich, and I talk about my interpretations and insights into financial markets and the global macroeconomy. Volatility continues with the 10% spike, call it every day in the VIX. The 10 years trading, sub 1.5, a little over it went after Powell spoke this week, and call option volume continues to stay at those elevated levels. And really the only outliers of this week's pullback were the dollar kind of creating this base from the 90-91 handle. And of course, you got energy, you got financials, you got industrials. They all rallied a bit higher, obviously, as interest rates are rising, and tech continues to roll over. And you can imagine what Cathie Woods is thinking. In fact, she even said this past week, Zoom, which has been retracing to the downside risk quite a bit, along with all the other tech stocks. She claims that it's a very, very cheap stock at the moment, but not surprising with rising yields and a pretty short-term rising dollar, that precious metal prices are being discounted just a little bit, maybe potentially a bit. But I think speculators will learn in time that higher interest rates are actually very, very good for precious metal prices. And remember, the dollar is still under tremendous selling pressure from its cycle peak from all the way back to 2001. And the bond market actually gave us quite a lot of warning signals of potential stock market volatility, as the MOVE index which is a kind of yield curve weighted index, right? It measures bond vol, and it continued to diverge pretty far from the VIX. I mean, it's pretty much the 2013 taper tantrum all over again in context, because clearly the bond market is fearful of rising interest rates and inflation. So if we actually correlate on a chart the VIX and the stock market's put to call ratio, you'll see currently, or at least within the past few months, there's been a large, even more widening divergence between the two metrics. And the VIX actually is probably at about 100% or so above historical levels, right? Historical lows are probably at the low teens. And then you got the put to call ratio for the stock market at record lows. I mean, it couldn't possibly be lower. And so this relationship, and obviously that means the put to call ratio being at record lows, is that everybody's net long stocks in speculative terms. But this relationship has only diverged recently. Many years before these recent months, we've seen actually a very tight correlation between the two metrics. But I mean, now the two have widened significantly from each other, which definitely signals room for stocks to crash, in my opinion. But of course, in today's bloodbath, or rather yesterday's bloodbath, the NASDAQ turns red for the year, and the 10-year rose above that 1.5 threshold as Powell spoke. And also the spread between the 10-year and 2-year is at its highest point since 2015. So that gap is only widening. But of course, we all know what exacerbated today's sell-off in stocks and higher yields, as well as yesterday and really the day before, really this whole week. Powell literally said that, the past day, that the reopening of the U.S. Will probably enable upward pressure on prices, right? I mean, he notices rates going rapidly higher, but still, not to my surprise, he won't take any action until rates go even higher, which is just ridiculous when you know that the banking system is going to be overflowed with over at least $1 trillion in new bank reserves. And the fact that about 60%, a little bit less, of all federal government spending just in the past year was unfunded, right? So all that spending was unfunded, or really, i.e. deficit spending, which apparently means universal basic income is a serious attraction for the federal government. But overall, no surprise with Powell's atypical comments about employment asset purchases, these large scale asset purchases, QE. And speaking of the Fed, I mean, their balance sheet actually saw what I would call a temporary contraction, really just due to the mortgage-backed securities being reduced just a little bit. So the balance sheet is at the same level it was back in the middle of last month in February. But I can imagine this will only be a temporary contraction since massive asset purchases and fiscal policies and new stimulus, that's all going to reverse the balance sheet much, much higher, in my opinion. And now, since we mentioned briefly, and the fact that we always talk about changes to central bank balance sheets, I definitely want to focus on the rest of the show on the 2013 taper tantrum, because, of course, it puts a spotlight on our dear friend Ben Bernanke. But basically, the taper tantrum occurred in 2013, and we saw interest rates spike pretty drastically because the Fed displayed very hawkish attitudes and comments pertaining to cutting the QE program back from the housing crisis, back from the great financial crisis of 2008. So when Bernanke testified to Congress that at some point in the future, the Fed will cut bond purchases, literally everyone started selling bonds immediately, which means obviously the yields on those bonds skyrocketed higher. But it wasn't just bonds selling off. I mean, it was pretty much the whole 9 yards. Everything was going down, most notably emerging markets. And, since EM actually closed negative for 2013 for the year. And keep in mind, in an environment much like today, where it's dominated by monetary and fiscal power, if you look back at the great financial crisis in 2008, you'll see the Fed actually tripled the size of their balance sheet by buying about $2 trillion or so in treasury securities in order to suppress interest rates, which of course made investors too comfortable with easy money. And so when Bernanke made that huge hawkish announcement, you can say he pretty much pulled the lifeline on those that were dependent on this kind of levered environment, those that didn't have collateral. And in just the same month that Bernanke testified to Congress, which was in May, I believe. I believe it was in May where he testified. We actually saw the S&P down over 5% that month. And obviously, going to 2014, where we saw the bears just absolutely crashing into oil. Oil got crushed. And of course, don't even forget, we had about the same headline inflation in 2013 as we do right now at sub 2% Fed inflation target. The Fed has had the same 2% inflation target for over a decade. So I'll end with you exploring this question. After Powell spoke about inflation this week, we saw the 10-year, up and over 1.5 like it was nothing, and risk assets obviously selling off as a result. But replace that 1.50 with 2.50. What happens then? And eventually, potentially beyond that, what happens then? Well, this is all I wanted to cover for today. I really hope you enjoyed, and please don't forget to comment and like and subscribe to the channel. Also note, I'm not a financial advisor, and everything I say is entirely for educational and informational purposes only. All right. Thank you, everyone, and have a great weekend.